Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's July 18th, and I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. As you know, I've been listening to my podcasts. I'm in Vancouver right now at the Sprott conference, visiting lots of companies, meeting up with some of my best contacts in the industry, including Marion Katusa, Jeff Phillips, Rick Rule, Van Simmons, lots of names. We have great ideas for you once I get back. So be sure to listen to Friday's Frankly Speaking. I'll cover some of those ideas. Of course, the best ideas are going to go for my paid clients, who's, for my subscribers, of course. But I'll talk about some of the trends I'm seeing. Again, an industry that's completely beat up. You guys know what happens when that cycle turns. And it hasn't turned once, right? Which we were able to time pretty well in early 2016. And you can see those gains 3x, 5x, 10x pretty easily when that happens. But overall, it's been a horrible industry. We did take some losers on our portfolio. But I want to get the scoop from some of the best companies. Going to have probably 100 to 200 companies there and have tons and tons of meetings set up. So be sure to listen to Frankly Speaking podcast. Also, if you have any questions or anything on that conference, make sure you email me, frank@curzioresearch.com. And that's Frankly Speaking's another feed. So you have to go there and find it on iTunes. Frankly Speaking, just put my name in there, click subscribe, and then, I take questions from you guys. Whatever you need. Ask me whatever you want, frank@curzioresearch.com. And that's just a Q&A podcast for those of you who have not been there before or listened to it. So, since it's a busy week, always want to put together a great interview for you. And this one's going to be fantastic. It's my good friend, John Petrides, Managing Director, Portfolio Manager at Point View Wealth Management. He's a guy you've probably seen often, CNBC, Fox Business News, gets called upon a lot in the media. Why? Because he's a good stock picker and a great analyst. And I really love having this guy on. I really do. And I get incredible feedback because you're going to see during this interview, which we're going to cover earnings season, and we're really going to cover it and break down all the numbers, what to expect, what conference calls to listen to, the red flags that you could spot in some of these conference calls, the winners, the losers, and sectors, and like John always does, is going to share a lot of individual companies that he really likes, companies that maybe you have to avoid. And again, right in the middle of earnings season, by listening to this, I'm being dead serious here, you're going to know more about this earnings season than probably 98% of investors out there. That's how much we're about to cover. And you know what? Let's get to that interview right now. John Petrides, thanks so much for joining us again on the podcast.
Hey, Frank. Great to hear from you, and thanks for having me back on.
Well, I always love having you on, and my audience loves having you on right ahead of earnings season because we really break this down because it's important, and we're kind of junkies. So we love this stuff. Right. Love listening to conference calls. Love seeing everything that's going on. And for me, and I know you as well, is, what are we expecting? I want to set the backdrop here for everyone first before we get started, because last quarter we saw 20% plus earnings growth, more like 24%, which is incredible, strongest since 2011. Sales growth is really strong, grew 8% year over year, also highest in about 7 years. So we're not just talking strength from tax reforms. It's more than that, which tax reforms obviously contributed. Energy led the way, with something like 80% earnings growth year over year. But that number's a little misleading because it came off of such a low base. But if you look at materials, tech, financials, very strong last quarter. Real estate, consumer staples, healthcare were the three weakest, showing less than 10% earnings growth. Now we're heading into second quarter. Expectations are high. We're looking again for 20% plus earnings growth, which what I found interesting when I'm breaking down these numbers is last quarter ahead of earnings, and this is around March, we have analysts that predicted 18% earnings growth and turned out to be 25%. But their forecast at that time for the S&P 500 was for it to grow 16% over the next 12 months. Now, fast forward to today, because it's going to get to everything we're going to talk about here. They're expecting around 20 to 25% earnings growth. Again, these analysts expecting strong sales growth, but they actually lowered their S&P 500 target from 16% to 13% when we're trading at the same levels that we're trading in March, which means what has changed? Because now it seems like these guys are seeing a little bit of risk on the horizon, even though everybody's talking about the positives. Again, just wanted to set that up Stage is yours, John. What do you think?
Yeah, so, bigger picture, I am a bit nervous coming into the earnings season. I mean, 20% earnings growth expectations year over year this late into the cycle, man, that's a high hurdle to jump over. And what I'm fearful of is there are three variables that analysts have a hard time, just because the nature of the variables, calculating that could throw earnings estimates for a loop. The first one is the strength of the dollar. The U.S. dollar was very strong in the second quarter on the back of, obviously, the Fed raising rates, talking about a fourth hike by the end of the year. You had the elections in Italy, which threw concerns into Europe. Trade tariffs put concerns into China and the rest of the global economy. So the dollar was a place for safe haven. And, about 40% of the earnings of the S&P 500 are outside the U.S. They have international exposure. So, a stronger U.S. dollar could actually hurt corporate earnings from an FX translation. So that's number one. Number two, maybe it's a little early in the game, but it's going to be interesting to see what the trade tariffs that have been imposed so far, if they've had any impact on cost of goods for companies, particularly in heavy industrial space that have exposure to steel and aluminum. And also, what will comments from management, from the CEO and the CFO about future earnings and the impact of tariffs? Because it's not, as we all know, with stock, it's not what you report, it's what you guide for. And so you could have a company that beats on earnings and beats on revenue, but guides lower going forward, and the stock could be off 10% that day. So I think that's another variable. And the third one is, listen, energy, the price of oil has been above $60 for the entire year and cracked $70 per barrel during the second quarter. So the price at the pump on a national average is about $2.96, just below $3. That's going to have impact on transportation costs and other costs of goods for companies. So that could impact margins as well. So with a backdrop of a 20% increase in year over year from analyst expectations, you have three wild cards out there that could impact earnings. Now, the only saving grace to this, in my opinion, is that the price to earnings multiple, the PE multiple, is at about 16 to 16.5 times on a forward earnings basis. So what does that mean? That's about where the market has traded on average for the past 60 years, 60. So from a multiple standpoint, we're at about average. I'd be significantly more concerned if we had a 20% earnings growth with a 20 times forward PE, which means the market would be set up, with the expectations for there is no way to fail. At least here, there is some concern and trepidation because PE multiples are a little bit lower. So I guess, I'm cautiously optimistic about earnings estimates this quarter, but I'm definitely more concerned than normal.
Yeah, and John, I just want to say that I love you because before I could even get the question out, that's why I love having you on the podcast, is I was going to ask you because, and guys, this is very difficult for analysts sometimes, especially when they come for your portfolio manager, and we say things that people sometimes, everyone understands in our world, but we have a lot of individual investors listening. So you're saying things like, the dollar, like people might say, well, the dollar's strong. Why is that bad? And you're saying, well, most of their earnings come in S&P 500. But when you look at small caps, that's actually a benefit because most small caps do business only in the U.S. They don't have a huge international presence. But just explaining that and also explaining the guidance, you can tell you're a pro when it comes to this podcast and showing that, John's exactly right. It is about the guidance, right? It doesn't matter what they report. I won't say what doesn't matter at all, but if they report really strong numbers and lower their guidance, that stock's going to go down compared to if they report weak numbers and very strong guidance for the next quarter in the year, that stock's probably going to go higher. So you want to look at the guidance, which is very, very important. Now, you brought up some interesting things because you talked about commodity inflation. Almost every CEO from last quarter was talking about that. You're looking at inflation and oil prices and things that you just said. Now, what does that mean? What do I want to hear? So for me personally, I look at companies like Delta. Delta came out and said, we're seeing higher costs as a transportation company, like you said, and they're saying that, but right now everything is cool and we're able to pass those costs off. I think in this market, you're going to see a lot of CEOs say that, because you forwarded me something which was interesting with Pepsi, right? Pepsi actually went up, but what did they say? You highlighted it and sent it to me. You said that what is it? Currency is witnessed by the recent sharp rise in the strength of the U.S. dollar. That's a risk, and also ongoing commodity inflation. That was Pepsi who just reported. So for me, and I guess my question is to you, where it seems right now in this market where the economy is pretty strong when you look at everything, you look at what is it, almost $6 trillion in I don't know if you saw that stat, John, in home equity for people, for U.S. consumers, for homeowners in their homes, that it's untapped. I mean, we have a really good market. We're seeing companies so far very early in the season that reported maybe like 30, 35, all highlighting the same risk. It seems like they could pass on these costs right now, but what does that mean for the future? Because this is how inflation really, really gets going, right? I mean, it gets, I wouldn't say out of control, but we're seeing it right now, because they're going to raise prices to account for these higher commodity prices. It means everybody's going to be higher prices, and I don't know if that's really factored into the market, is it?
Yeah. So a couple of comments. The first is, I would encourage all of your listeners to read the transcript from Pepsi's earnings call, which was last week. Go online. It's very easy to find. I was viewing Pepsi as the bellwether for this market in terms of their earnings for a couple of reasons. A, consumer staples has gotten the snot kicked out of it year to date, right? So this is a sector where, they were formerly considered bond proxies because they had a big dividend, and with interest rates rising, they got killed. That's number one. Two, with commodity costs rising, particularly at the pump, and with tariffs, particularly a company like Pepsi, which sells aluminum cans as half their business, for what was that going to do to their margins? And Pepsi is a global company. So, what was going to happen with the U.S. dollar? And basically, Pepsi has been able to hold pricing, okay, and they were able to maintain their guidance for the year. Specifically, they called out because of a lower tax rate. So their costs did go up. They did see commodity inflation. They did not break that out between what was energy costs and what was tariffs. They just basically lumped it all together. And they did see pressure from a stronger dollar. But because of the lower tax rate, they were able to hold guidance. And because of that, the stock was up 4% that day, and the market rallied as well. I do believe that if without the corporate tax rate, they would have had to guide their earnings lower. And I think that would have been a bellwether, and I think the market would have sold off on that news. Akin to, if you remember, Frank, in April, when Caterpillar reported their earnings, the Caterpillar CEO made a comment that they were in the high water mark of their margins. And man, the whole market sold off on that news. Industrials got destroyed because everyone basically extrapolated that and said we're at the peak of the cycle. So I was afraid that Pepsi may have had that type of impact to the overall market. So let me, on your other comment on the impact of inflation, I'm going to paint the worst case scenario that you could possibly think of in terms of where inflation could go and the impact of tariffs on the global economy, and that is a situation of stagflation. So what does that mean? Let's say we go on to this all-out, brutal, knockdown, takeout, tariff war, and the cost of everything goes up. And because tariffs are a tax, it lowers the overall global economy. But at the same time, inflation has to go up because everyone has to try to pass through the cost of goods because tariffs are higher, in addition to potentially higher oil prices. In that case, you have a situation of stagflation. What does that mean? The economy is stagnant, but inflation keeps rising. Now, under that scenario, in that scenario, the Fed can't do anything. In that case, you can't go out and print more money because then you're only exacerbating the inflation side, right? So what do? There is almost no place to hide, with maybe the exception of gold, in a stagflationary environment. I mean, that is the worst case scenario. I don't think we get there. I don't think, I do think that cooler heads will eventually prevail on trade tariffs. I do think that trade tariffs in general are not good for anyone. I do think the headline risk on trade tariffs is worse. Maybe the bark is worse than the bite, simply because we are an $18 trillion global economy. And although numbers are being thrown around in the hundreds of billions of dollars, tariffs have only been slapped on globally, maybe, $25 or $30 billion. Okay, it's not a huge number yet. Certain industries will get bitten, but it's not a huge number yet where it would derail the overall economy. So when you're thinking about the inflationary environment, to me, the worst case, the ultimate bear case that could come about because of rising commodity costs and the impact of trade wars would be a stagflationary environment, and in that case, all bets are off. You run to gold. So as a matter of reference, we typically have about a 2% weight to gold in client portfolios to protect against that black swan event. So when you're looking at diversification of your assets, I think that makes a lot of sense. Now, listen, you've done a lot of work on cryptocurrency, and many would argue that maybe cryptocurrency is the new gold because it is sort of an uncorrelated asset, and maybe that has potential to act as gold in the future as well.
No, and it may be, right? I mean, I don't know, because I know that I'm attending the Sprott conference, and thank you so much, you guys. We're doing this a little bit earlier than Wednesday so I can get a podcast out for you. So I'm just letting you guys know, because I don't want, John to talk about a stock that comes out on Tuesday that reports earnings and it goes down. You're going to be like, wait a minute, what just happened? But John's nice enough to do this early because I always want to get an interview out for you guys, and it's very important, and earnings season is always awesome. But the reason why I'm saying that the Sprott conference, because it's not only mining now, there's a lot of cryptocurrency companies, like companies getting into cryptocurrencies there. So you even seeing that in the resource capital of the world, where, I'm not too sure if it's replacing gold, but it's definitely having an impact on it, even though cryptocurrencies fell. Now, you brought up some good points, and I think you appreciate this, John, because I want to go over the math really quick. It's important because people say, well, what about tariffs? And it does impact certain companies. But here's when you look at the math, how it works. And it's going to take 2 seconds, guys. If you look at steel, for example, the average car uses 2,000 pounds of steel. So it's around 50 cents per pound, say, so $1,000 per car just for steel. So a 15% bump in steel prices due to tariffs amounts to an extra $150 more to produce a car. Now, the margins on a car are around $4,000, right? So I don't want to throw millions of numbers at you, but that 150 to the 4,000, it's a little significant. It's 4%. That's a very big number when you talk about margins. But what John, you just brought up is you have to throw in the tax reforms, because corporate taxes just got cut across the board from 35% to 21%. And you're saying the gross margin on a car, right? If we say $4,000, the difference in those taxes, or how much they're going to save, is about $550 in extra profit per car. So if we take the $550 and then we minus $150, you have $400 of profit. So we're still seeing companies do fine with the tariffs, because it's very small compared to everything else. And like you said, it's a lot of headline risk. I think a lot of this would be solved, but behind closed doors, which is going on right now. But when you're looking at the whole impact of everything, you can't just take tariffs and say, wow, we're so in trouble, without taking tax reforms, because it's easily covering the cost of companies, what you saw with Pepsi. Now, that begs the question, say if trade wars, tariffs, all this is figured out in a couple months, which I think is going to happen, and that no longer exists, is that a positive for the upside for some of these companies, especially like a Pepsi, especially like, again, aluminum companies? You have Whirlpool too, Harley Davidson, companies that got impacted by this. Is that something that you're looking for, or do you think this could impact them even more? Is it factored in? I mean, that's what we try to find out, right? We have all the numbers, but we want to know if it's factored in, and then you throw in, again, I'm confusing everybody here probably, but you're throwing in that earnings are really just trading at 16 times forward earnings. Guys, that historically we usually trade around, John, you probably know the number, like 15 and a half, I think.
Yeah,
right.
Yeah, right. We're pretty much in line. Maybe a slight premium to where we have traded historically, but we're pretty much in line.
Yet we have interest rates very, very low, and we're seeing much stronger earnings growth. So it's hard to say that, the market's going to collapse, but there are risks, right? So you're talking about commodities, and you want to know where I'm going with this. It's what's going to happen if tariffs gets worse, gets better? I mean, have you covered those scenarios? Because like you said, you're saying stagflation, you're an analyst, you always look at the worst case scenario and how you're going to play it for your clients. What about if we don't have stagflation, but we see, different policies coming out within, trade wars, trade barriers, China and stuff like that? Have you looked at those scenarios that could, lead to impacts in earnings going forward?
Yeah. So a couple of points. One, let's talk about, what the market is trying to price in with potential tariffs. And then the second thing is we can talk about, the bull and bear case of investing in stocks today, because I think both sides are actually compelling. It is hard to each side makes compelling arguments. So in terms of, what the market doesn't know quite yet, maybe of how to price in tariffs into certain stocks because companies haven't been able to digest or see the results quite yet. Although that's one of the things that I'm waiting to hear on certain earnings calls. However, look at what stocks that have an asset heavy versus an asset light business model have done over the past 4 weeks. Now listen, the FANG stocks, right? Facebook, Amazon, Apple, Netflix, Google have been crushing it for 3 years. Okay, and growth has been in favor over value from a style standpoint, and investors are piled onto momentum because it's fear of missing out. If you can't beat them, join them. These companies are the wave of the future. That being said, Facebook doesn't make drilling rigs or cars or heavy industry, right? They're a service, they're a media company, they're an advertising company, they're an asset-light business. So right now they have issues on the regulatory standpoint, but from a trade tariff standpoint, right now there's no issue for them. Same thing with Google, same thing with Netflix. Now Apple, there's some component issues that they can get caught up with China. Maybe Amazon in terms of even some of their components, but again, by and large, those companies avoid the tariff issue, and you have seen a run up in those stocks even further, and their valuations and multiples going higher. On the other side, look at Ford, look at Caterpillar, look at Boeing. Every time there's a headline, the stock sells off. So the heavy industrial companies, there is definitely trepidation. I can't tell you, 100% this is priced in or this is, going to happen and the stocks are washed out. So, if there's, reprieve and, if the tariffs come through, everything's priced into the stock. I think it's very hard to tell. And I do think those stocks have just kind of either sold off or have been weighed down because investors are afraid of stepping in front of the steamroller. So to your point, and, let's say October comes around and let's say the Republicans are losing in maybe the public opinion polls, Trump is going to do everything he can to make sure that the Republicans win as many seats as possible. And I would assume that automatically we will come up with some solutions to trade reform that will help the stock market move higher and will help the election side. So I do think that at some point in time before year end and before the election, things are going to get turned around. In that case, I do think the heavy industrial stocks that have been discounting something should do really well. In that case, Ford should do really well. Caterpillar should do really well. And maybe you see the asset-light businesses, sell off. Maybe there's a rotation out of one to the other because that fear is no longer there. And investors look at the relative value. Ford relative to Facebook is dirt cheap. That comes into play.
No, that's a great point. Now, again, I said that we're doing this early, but we did see some bank earnings that have come out. So I want to discuss those with you because for me, I've done a lot of research on the banks and just really dug in to see. I never realized how strong they are, the strongest that they've been in the history of our country, where they have to keep they're selling $300 billion of money on their balance sheet that they can't even touch. They're not allowed to touch, right? So and it's high quality capital, guys. It's not like this isn't mortgages or credit cards. This is money sitting in treasuries and cash that the government, based on the current system, Dodd-Frank, they're not allowed to lend it. They have to keep that on the balance sheet, right? It's like Apple, the government's saying, hey, you have $250 billion in cash, you have to keep $175 billion of that. You can't spend it, just keep it right there, which makes our economy safe. But you're looking at the banks, and they're trying to, they're generating record earnings, which is kind of amazing, even without tax cuts. So they're finding ways to make money. Chances are net interest margin is going to go higher, right? Doesn't mean just because we're raising interest rates that margin, that spread is going to go higher, but most of the time it does, which is going to mean more profits for the banks. What are your thoughts here? Because when I'm digging through some of these, it seems like they're all very strong across the board, but they are mixed. There's a little, pockets of this, pockets of that, and we're seeing what we're seeing in every earnings season. It seems for the last three now, at least the last three, where most of them reported pretty strong earnings, beat and guide a little bit higher, but we're seeing a pullback, and it's not just banks, but we've seen that pretty much through earnings season. What are your thoughts on the banks here, especially if you got a close look at some of these companies that just reported, the majors?
So my thoughts coming into the earnings season for the banks is messy. I was concerned about bank earnings this quarter, and I had expected them to have messy results, and that's kind of what you're seeing. J.P. Morgan beat on the top line, beat on the bottom line, and what do you say? J.P. Morgan clearly solidifies itself as the best banking institution in the world. Citigroup, misses on the top line, beats on the bottom line. Wells Fargo had mixed results. So, you're kind of seeing, not a uniform result here. You see messy results. And the reason why I was concerned coming into the quarter and why I was expecting a messy return is because the net interest margin, the yield, spreads have become really tight. So what does that mean? So the difference between a 2-year interest rate and a 10-year interest rate really in June really started to flatten out. So what does that mean? So if you go to your local bank and you wanted to invest in a 2-year CD, right now your bank will charge you about, let's say, 2%, make out round numbers. Okay. If you went to the same bank and said, hey, you needed a 10-year loan, they'll charge you a little bit around 3%. So the spread that the bank makes is 1%. A year ago this time, that 2-year CD, what the bank would have paid you would have been about 1%. And they would have charged you probably about 2.8% on a 10-year loan, which means the bank spread was 1.8%, much higher than it is today. So the fact that the short part of the curve, 1 to 3 year bonds have risen, and the longer dated curve, longer part of the curve, the 10-year, has actually come down to below 3%, means that the spread that banks can make on paying money to savers for CDs and loaning to lenders has tightened, which is going to hurt their top line. So, if that curve doesn't normalize, where it inverts, where it gets steeper, meaning the longer part of the curve rises and the shorter part of the curve comes down, so that spread is wider, the banks are going to have another rough quarter as we're into the third quarter here. So now that's short term. Long term, I love the banks. I really do think that the banks, we talked about, listen, Frank, we are 10 years ago from, we're going to be marking the 10th anniversary of Lehman Brothers coming down and the financial heart attack that the global economy suffered. No one on this call, on this podcast right now, was not affected by that issue 10 years ago. I mean, 10 years ago, Frank, I was at Bear Stearns Asset Management, which was essentially ground zero for the financial crisis. Okay. So, but here we are 10 years later, and the balance sheets of the banks have been the healthiest they've been post-World War II. I mean, all of the loan numbers that the banks are reporting are actually really high quality. They're only, the reason why they're not buying back more stock than they currently are, the reason why their dividends are not growing faster than they currently are is because the government, the Federal Reserve, won't allow them to do so because they don't want a repeat of what we had a decade ago. So, a company like Citigroup, which is trading at slightly above its book value, is really attractive. I mean, Citi was a $76 stock at the end of last year, and now it's $66. I don't own Citi personally. Some of our clients do own Citigroup. Same thing with Bank of America. I think Bank of America is really attractive here, where, again, it's not trading at an egregious premium to its price-to-book multiple. So I guess short-term way of saying, any pullback on the banks, I would be buyers. Because I do ultimately think that interest rates do go higher, even if they're in a gradual level. And I do think that net interest margin spread, the difference between a 2-year CD of what the banks have to pay out to what they charge on a longer dated loan will widen, and that will ultimately help the banks make more money longer term.
Great stuff there, and thank you so much for explaining the curve and what that means with net interest margins too, because I know investors love that, and some of us already know that too. But it's just great to really get to detail. I appreciate you doing that. Now,
yep.
When it comes to, let's go outside of banks, as I was going to say, what are some of the sleeper sectors where that you may see earnings where real estate has really trailed the last couple of quarters? It hasn't been too good, and there's others. But one of the things that you did say is industrials, and outside of guys industrials, if you throw Caterpillar in there, if you throw Boeing in there. Yeah. But overall, if you look, a lot of industrial companies, they really haven't performed that well. I mean, it seems like that there's bargains in there, and you have an infrastructure bill that I think it is going to happen. And if it doesn't, it's going to be very sad, since both parties ran on $1 trillion infrastructure bill. So you'd think that for the sake of everybody and the safety for some of these people and bridges collapsing and things like that, that they can actually get together without playing politics to get something out there, because we actually need this, right? Everything, if you look at all the studies, this isn't, politics aside, if you look at bridges, dams, if you look at our water systems and pipes and stuff, it's very outdated, and we need that to be upgraded, which is going to benefit some of these companies, not right away, but that news could push a lot of these things higher. So, I don't know if you want to go a little bit more into the industrials, but what are some of the things maybe during this earnings season that you're looking for that, because everyone's saying, well, let's see what the FANG stocks report. Well, technology is good. Let's see, the banks are very important as well, which, filter out to the whole economy. But maybe a sector inside there? Is it, materials that have been doing okay? Is it healthcare, right? I mean, I know you talk about healthcare, but that's lagged on the earnings front over the past couple of quarters. What are you specifically looking for, maybe from a sector point of view during this earnings season?
Yep. So I think although it was, I think maybe the best performing sector in the second quarter, I think the numbers are going to be blowout, is the energy sector. I mean, listen, Frank, in January 2016, barrel of oil touched about $25, and now we're at 73. You've had like a 300% increase in the price of oil over a 2.5-year period. And if you remember 2016, the energy sector, all the oil guys had to deal with the rating agencies and say, hey, we're not going to be default on our loans. So they slashed their CapEx budget tremendously, all of 2016. And, that doesn't come back automatically. So I still believe that, the price of oil has gone up 300% in 2.5 years. And I still believe that the energy companies are lean from an operating standpoint and have not brought their CapEx back to where they were pre-2016. So I think that energy, although it was the best performing sector, I think those companies are just going to destroy earnings this quarter. I think that's going to be a massive, massive shot. Now, unfortunately, from a market standpoint, the energy sector is only 6% of the index. I mean, when we're talking about what's the market going to do, guys, tech is 26% of the S&P 500. So the impact of technology earnings results is clearly going to drive more so than what energy will do to the overall market. But I do think from a sector standpoint, energy is just going to blow it out of the box. From a longer term standpoint, I think healthcare is one of the more attractive sectors in the space. Again, I do believe that the fundamentals of a growing and aging global population is only going to utilize the healthcare system more as we go forward. And listen, healthcare was the best performing sector per year from 2010 until the summer of 2015. And that's when you had reports of people like Martin Shkreli, and you had the Valiant issue, and you had this, egregious and disgusting, price gouging for drugs. And, tremendous amount of regulatory and oversight started pouring into the industry, and the whole chain within the healthcare, either from the big pharma guys down to distributors, they all got clipped because they had to cut back on pricing that hurt everybody's margins. But, by and large cap healthcare, and I'm not speaking about biotech here, large cap healthcare to me is very, very attractive from a valuation standpoint, from a balance sheet quality standpoint. And again, I think the long-term growth trend for the sector is very attractive. So short-term, I think energy blows it out of the box. Long-term, I do think healthcare is the better investment, better place to park your money.
And it's funny because as you were doing that for me, and guys, I do this all the time because when I'm talking to my guests, I'm just fascinated because I'm always getting a different perspective, different point of view, and I'm like researching as you're talking just to look at healthcare. And when I went to, I just pulled up a simple chart because we're talking about earnings, and I'm going to ask you such an easy question right now, John, just for you. So get ready for it. But when it comes to healthcare, and I think I pulled up, actually, this is what I just threw up, XHE, which is more of like a healthcare equipment. But so you're looking at earnings, and this isn't in general with the whole earnings. I just try to do it really quick. But what I'm seeing is something that outperformed over the past year, the S&P 500 by 2-1. I mean, this is up like 32%. The S&P 500 is up around 15% over the past 12 months, not year to date, but over the past 12 months. Yet we're seeing healthcare, at least the last 2 quarters, and I also expected this quarter where they're reporting what in terms of sectors, they're basically on the lower half. So What explains that, where we also see in consumer staples on the lower half, and you could say, okay, well, some of them are still performing well because of that high yield, but how do you explain healthcare and things like that, where what's the disconnect, which is a very tough question. So I'm asking, I'm curious how you can answer this, because what investors may see, they're looking at and say, well, earnings aren't that good. Earnings usually drop prices, but yet you're seeing healthcare, go through the roof. It's been a very good performing sector over the past 12 months, outperforming the markets, but yet earnings are going lower. So does that give you an opportunity to say maybe, I guess what I would want to know is that why is that outperformance happening when they're seeing, slower earnings than probably everybody else?
So I think from an outperforming standpoint, particularly in 2017, remember in 2016, healthcare was the only sector in the S&P 500 to finish negative for the calendar year, the only one. So I think from a relative value standpoint, you had a rebound in 2017 as investors scooped up stocks that were bargains. So I do think that was a big reason why healthcare rebounded. I also do think that at least in 2017 initially, the market was relieved from a healthcare stock standpoint, that Trump won rather than Hillary Clinton. Because I do think that Hillary Clinton was the first person to tweet or fire the shot heard around the world in August of 2015 that took the bubble out of healthcare stocks and started putting pressure on drug pricing. So the fact that Trump won, I think that let certain investors in that sector breathe a sigh of relief that helped push the sector higher. In terms of why the earnings have not performed well, again, I do think it's all based on drug price compression. Drug prices have come down. You look at, and there's been tremendous, competition. Remember Gilead, which is a stock that I own personally. I pitched it on to your audience in the past. I still love the stock, still own the stock. Clients of ours own the stock. In 2012, they bought a company called Pharmaset that basically had the wonder drug to cure Hep C and Sovaldi, and they were charging like $12,000 per pill, and their justification was, well, you're one and done, right? So it saves so much cost in the future because you take the one pill and you're cured. Well, many other competitors came in with their own solution to Hep C and at cheaper prices, and it forced the price of Sovaldi down. So you have a lot of competition coming into the market. Again, the regulatory standpoint, you've had pressure on drug prices. The distributors, look at McKesson, Cardinal Health, AmerisourceBergen, ABC. Those are the three big distributors in the industry. Not only are they dealing with the potential disruption with Amazon's recent acquisition of PillPack, that drug distributors are very low margin business. So if they can't get any increase in pricing, or if they get pressure on pricing, that gets passed on through, and it hurts their profit margin. Look at CVS and Walgreens. Those are considered healthcare stocks. They may be doing okay. They're feeling some pressure on the drug pricing as well. But remember, half their business is as a retailer, and they're getting clipped on the e-commerce side. So you have a lot of issues going on within the healthcare space, but mainly it all in terms of earnings standpoint, it all revolves around drug prices coming down.
Yeah, and it is interesting, right? Because with that sector, and this is why I say, like, a lot of times when I'm listening to things on CNBC or different channels, and most of it is good, but some of it is just, the reporting is kind of like, I laugh sometimes because it's not really a big deal, but it's enough to push, markets down, like a Trump tweet, where this is recently just happened about Pfizer, where he tweeted about Pfizer and the price of going up. And then Pfizer actually came out and said, okay, we're going to postpone drug price hikes for now, which is cool. But with that said, healthcare is so tough because, when you look at the system, guys, what is it, a 20-year patent that they have on these drugs, but it takes about 12 years, 11 years to really get this thing. If everything goes good, phase 1, phase 2, phase 3, and approval, it's like 12 years, over $1 billion in costs before, you even start making money on this. So, I could see these are companies that are for profit, right? So they want to generate profits. One of the biggest disconnects I see with tough, and you might agree with this, is when it comes to the orphan drugs, which treat rare diseases, because the rare diseases are only in a very, very small amount of the population. But when these companies go out and they're going to spend that much money, and it wouldn't be like $1 billion, probably less, but they're given special status by the FDA to accelerate that approval process. But even with Valiant and some of the things, some of the drugs, it's not a cholesterol treatment drug, right? Which we have thousands of them these days. This is a special drug that may be able to treat, whatever, Dravet syndrome or different diseases but in order for them to make their money back, they have to charge $25,000 for the treatment. Yeah. And that's when we have our politicians going, what are you, crazy or nuts? And it kind of leads to, like, if I'm a company and I want to create these types of drugs that could treat rare diseases, you're going to get crushed and lose your money, and you're going to go bankrupt, even though you're trying to do a good thing. So is that something you look at where, Gilead too, when you have companies where they have a specific drug that's the best to target a disease and it really works, it's hard not to charge a lot for it, but you always want to maintain the cost. Is that always going to be a risk going forward? Because our politicians love tweeting these days and showing, just anything. They'll look at a poll, people are pissed off. Okay, let's say that these guys have to lower drug prices.
So let me give you, I guess, my background on healthcare and how I view and how we view the sector. Frank, I am the furthest thing from a biologist. Okay, I'm the furthest thing from a scientist. In fact, half of the healthcare companies that we look at, I can't even pronounce the drugs. All right, so I don't pretend to say, you know what, company XYZ, their pipeline looks tremendous, and I think by 2026 this is going to be a great drug. No, I have no idea. And most of the analysts out there, God bless them, they're doing the best they can, but they don't have any idea either. Okay, so typically when we look at healthcare, I like the logistics side of it, so the distributors, right? Because it's not about what drug they have in the pipeline. It's about, they fill a certain need in the supply chain. I like the names like Gilead, Celgene, although we don't own Celgene across, certain clients do it. I don't own it personally. Celgene is actually in the back door. They're in Summit, New Jersey, where our firm is. They're the same boat as Gilead is, right? They have this one major drug. It's a cash cow. They have this war chest of a balance sheet. They've had some things fail through their pipeline. And what Gilead and Celgene will be doing going forward, and they've already started this process, they're just going to buy their top line. Why invest so much money in an R&D pipeline which may or may not work? Why not go out into the biotech space and just start buying up companies that you think have a shot? And, you work with your M&A team to strip out synergies and bolster your pipeline that way. And both of those companies have a war chest of cash flow where they can do that. So I feel more comfortable, hiding in those type of companies in the sense that I have the balance sheet to support me if things don't go right. And I'm, making a bet that management is effective enough, they know what they're doing, to go out there, and because they do have a good history, a good proven history, a good track record of making solid acquisitions. And I'm not overpaying for either stock because they're both attractive from a valuation standpoint. So, one of the lessons that I learned when I began this industry back in 2004, okay, Pfizer, again, I was on the large cap value team within Bear Stearns, and Pfizer was a big holding. And my portfolio manager at the time brought up, I'm nervous about Pfizer. He said, why? Well, in 2012, Lipitor is going to come off of patent. Now, we're in 2004. We said 2012. Who the heck's talking about 2012? Well, at the time, Lipitor was 50% of Pfizer's earnings, 50. And when that fell off, if they didn't fill that gap, Pfizer was going to be in a lot of trouble. And guess what? Pfizer had a really time filling that gap. I mean, the only way they've been able to really plug the hole is they bought Wyeth in 2009, and they've done some other acquisitions, and they've spun off Zoetis, and they've done a whole bunch of other things, but they haven't been able to come up with that huge blockbuster drug since then. So, that has been a bit of an issue, and something that, I'm conscious of and careful of when looking at the space. By the way, we own Pfizer for our clients, and I don't own it personally.
Okay, cool. So, all right, last thing here, because we're covering a lot. You're one of the guests that come on that, and everybody loves you because you're always giving out, stock ideas, which you already did, especially in healthcare, the sectors that we spoke about in industrials and banks. Outside of those, what is some of maybe stocks that you're looking at? And just for me, I have a list of at least 40 companies in the S&P 500 that I want to listen to their conference calls that I like, and I want to see what is going on and give me an update. So I want you guys to understand, again, we're doing this a little bit earlier, and maybe one of these companies may report in the next couple of days, but what are some of the things maybe that are on your list of specific companies that you're looking at during earnings season that maybe you own already, or something that, if something triggers, or if you see something you like, this might be like your next position that you recommend to your clients?
So two stocks that I like, completely different companies, and I own them, both of them, and we own them for clients. One is Bright House Financial. The ticker is BHF, Boy Harry Frank. And this is a spinoff from MetLife. And it's MetLife's old retail variable annuity and life insurance business. And man, this stock spun off about a year ago. And it was a small spinoff. So you basically, for every 11 shares of MetLife that you owned, you got 1 share of Bright House. So for a lot of investors, it really looks like a stub in the overall portfolio. And what happens often, as you know, Frank, with spinoffs, when you get these small stubs, maybe you just don't want to do the work on it, or you don't know what it is, and it looks like a small position, so what's the point? So I'll just sell it. And that has happened a lot, particularly for institutional clients, where managers are just selling off these small stubs because they're not looking to invest in it. Well, Bright House Financial has gotten crushed. I mean, the stock is down to about $40 a share. It trades at about, 0.4 times book value. So it trades at about, for every $1 of book value, it's trading at about 40 cents. And, this isn't a company that's in trouble. Life insurance and variable annuity companies do well in a rising interest rate environment. So I do think interest rates will rise over time. This is a high quality company with a rich tradition. It just has a different market, just different name. So I do think the sell-off is way too much, and I trade at a big discount relative to other annuity companies from a book value standpoint that I just don't think is warranted. And I think a lot of it has to do with the fact that it's fairly brand new as a standalone company. So I think Bright House Financial is a really attractive company here. The other stock that I like is Vodafone. VOD is the ticker, and Vodafone is one of the largest mobile phone operators in the world. This stock, again, this year has gotten killed, and it's caught up in a couple of issues. One, it's a UK-based company, so there is some concern about the upcoming issue with Brexit and how that's going to impact UK companies in general. The second thing is, again, it's an international company, so a stronger dollar is bad for international stocks. In fact, international stocks are negative for the year from an index standpoint. So I think that has hurt them. And it's a telecom stock. Telecom is the worst performing sector in the S&P 500 year to date. And finally, it pays a huge dividend. The dividend yield is about 7%. And high dividend yielding stocks, income-oriented stocks. In fact, remember for the last 8 of the last 10 years, how many times did we talk about the hunt for yield, right? The hunt for income, because we can't find income anywhere. Income today is probably the easiest it's been able to find in the past 10 years because interest rates have risen. So anything with a high dividend yield, whether it's telecom stocks, REITs, utilities, consumer staples, man, all those stocks have sold off where their income is actually quite attractive right now. So, if investors are out there looking for income, it's there to be had. And I don't think, Vodafone sold its stake to Verizon Wireless back to Verizon in 2014 for $133 billion. And the company returned a lot of that to shareholders through a special buyback, a special dividend. They bought back stock, and they've been out there acquiring assets, and they're looking to transform their business similar to what AT&T did with Time Warner, where they're trying to add more broadband and media assets to their portfolio so they diversify away from a pure mobile phone operator. So, although the yield is high, I'm not concerned. I don't think there's any going concern to the yield of Vodafone. So there are two names that I think they're polar opposites, but I do think from a valuation standpoint, they're compelling at current prices.
Yeah, and I think that's what people love about you, at least my audience, is because, when we do these, we go everywhere. It's all focused on earnings, and now we're going different industries and different stocks, and it's always relevant, right, whatever we're talking about, because we can go to the banks that reported already and stuff. And, again, I know my listeners really, really love that and getting that update at least once in a quarter from you. So, John, thank you so much for coming on. I know how busy you are and coming on short notice because I am going away and leave it a couple days. And, you're always there for me and stuff like that. And always there to you never have, well, I don't know if I should say it, but never half-ass anything. So you come prepared. You're always great. And I know people love it. And I really appreciate it. I know they do too, man.
Yeah, Frank, thanks a lot. Safe trips. Look forward to hearing your comments coming back from the back of from the trip. And if I could just throw out, if people want to follow me on Twitter, I'm at J_Petrides. And, our website is www.ptview.com or Point View Wealth Management. So just throw it out there as well.
And throwing it out there as well is you do have like free reports that you actually provide people too that you send me sometimes as well when those things are written up, which is, I don't know if it's a blog format or anything, but they could also find that on your website as well, correct?
Yeah, no, we have an article section. My CIO posted 10 stock ideas for the back 9 of 2018. So you take a look at those. Vodafone and Bright House are 2 of those names on that list. And we just published our recent quarterly newsletter. So, please feel free to take a look. It's all available. You don't need any special sign-in or password or any commitment to view any of that.
All right. Sounds great, bud. Thanks so much for coming on. I appreciate it.
Thanks, Frank. Take care.
Hey, guys, great stuff from John, as always. And it's a guy, just said, always prepared. I could ask him anything, tough questions, hard questions. And what I love about him is someone who does these interviews is, sometimes we'll go over topics. So with John, with guys like Andrew Horowitz, it's kind of like 3 bullets and that's it. And we won't even talk until the interview and it's great because it's not scripted. We go wherever it is, wherever, I feel like I want to learn or my listeners want to learn about different things. So that's where the interviews really go well because sometimes people listen, it's just, and they get in media and things like that. You have a Jim Cramer who's very, very exciting. And then you have other guys that might be a little bit boring. And unfortunately, it's usually the people that are kind of like, half and half that just really smart, but maybe don't come over great in the media. And John is one of those few people that's just a great analyst, comes over great, is able to explain just his ideas thoroughly to investors. And, it's kind of rare in the industry to have the whole package, and John does. And I'm a big fan of his, and I know he really cares, so much so that, a lot of his ideas have done great. And what was one of the ones he brought up was Gilead because he gave it about 2-3 months ago, the last time he was on. And I know that stock has come down. And that's one of the ones he wants to talk about because he understands that responsibility that people are actually listening to you and investing in it. And him telling you, well, we're just updating. We still like it. We like it here. We think it's going to go higher. We're still in it. Just shows the credibility behind a guy like that, which I really, really like. So he's a good friend. He's always been willing to come to this podcast. And more important, he gives it's all. It's always a really great interview, and I appreciate it. Now, guys, come back on Friday. A lot of fun. Yeah, if you're looking for some ideas or have any questions about the resource industry or cryptos, yes, I said cryptos. Be sure to email me at frank@curzioresearch.com. I said cryptos because the mining conference now, a lot of these, you're going to see crypto companies everywhere. That's the industry. So it's not just mining and gold and boring stuff. Now a lot of these companies, a lot of management teams are getting into cryptos, and they're making their way into these mining conferences. So I'm meeting with a lot of those companies as well, which is going to be great for crypto intelligence. And so when I get home from the Sprott conference, about 2 days, wealth of information from some of the greatest sources I mentioned earlier, Marin, Rick Rule, Jeff Phillips, Ross Beatty. Meeting with several crypto companies. It's going to be a lot of fun, really cool. But if you want any information, have any questions, be sure to email me. frank@curzioresearch.com. That's frank@curzioresearch.com. He's going to have a lot of great, great information. I love attending this conference and catching up with some of the best names in the resource industry. So, guys, that's it for me. Thanks so much for listening. And I'll see you in just 2 days if you listen to Frankly Speaking on Friday. Otherwise, I'll see you in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.